Today, Canada's central bank held the benchmark interest rate at 1%. While the Bank of Canada's decision today was already widely expected, the question has become about the potential timing of the interest rate adjustments. Joining me now to discuss today's rate decision alongside the outlook for the Canadian economy is Rob Carnell, Chief International Economist at ING in London. Rob, what kind of factors are the central bank fighting against here? And do you think the central bank's best option right now is this wait-and-see approach?
Well, I suppose the factors that central banks like the Bank of Canada are fighting against are a little different than some other central banks, the ECB, for example. I mean, the Bank of Canada's got several major issues. One is that its domestic economy doesn't look too bad, and in that it completely stands out from most of the rest of the G7. They do retain a tightening bias, which could have been dropped at this meeting. So they clearly think that the next move is up, but I don't think anybody's expecting any tightening from them anytime soon. The market's not really looking for anything until about mid-2014, and the consensus doesn't expect anything until about mid-2013. So really their major concern is keeping that, if they're keeping that bias in place, hoping that that doesn't translate into a much stronger dollar, because I think if the CAD strengthens much more, their terms of trade suffer a bit more, then the strength that they've been showing could actually be threatened.
What about the accompanying monetary policy report we'll get tomorrow? Are you expecting much from this?
Well, not really, no. I mean, the major hints in the statement that we've just had suggest that they aren't really going to be changing very much at all. The GDP forecasts, which Governor Carnell had basically flagged pretty clearly were going to be cut, it appears to have been trimmed only very, very marginally. So he's still expecting Canada to grow something close to its trend growth rate of about 2.5%, but it's still a pretty impressive rate of growth, and consequently they're not really expecting inflation to be that much lower than they were anyway. So I think very marginal changes in the monetary policy report that we're going to get shortly.
What about your growth forecast then? Where do you place Canada this year and next year in terms of economic expansion, also in comparison to other G7 nations?
I just got our Canadian forecast up on the screen here, and they look very close to the numbers that the Bank of Canada has just announced. So we're a little bit slower than them for this year at 2.2. I think we're bang on for 2013 at 2.3, and it looks like we're smack on the same as the Bank of Canada for 2014 at 2.5. So they're the numbers that we put together last month. We're not going to be changing them in our new forecast update coming out shortly. So the Bank of Canada seems to be converging on our slightly lower expectations for growth, but this is much better than pretty much anywhere else in the G7.
Of course, Canada's economic performance will also depend on any moves the Federal Reserve might take to stimulate the US economy. How do your expectations for the US economy and prospect of further stimulus fit in line with your performance expectations for the Canadian economy?
The US economy, it was going through a soft patch. That seems to be crystallizing into something rather more serious right now. And consequently, expectations are building, outside and in our own organisation for more stimulatory activity from the Fed. Now, exactly when and what form that takes is still a little bit up in the air. Our best guess is that it won't be at the August 1st meeting, but the September 13th meeting will see some stimulus. People are talking a lot about QE, but of course it doesn't have to be quantitative easing. There are other things the Fed could do, and frankly, after two bouts of this, we ought to be thinking a little bit more widely. For example, cutting the interest rate on excess reserves held on the current account with the Fed to zero, or even making them negative, might be an interesting way forward. I think one of the things that the Fed has to think about is trying to make the US dollar, at least stop it from appreciating further in this crisis environment, and so QE or cutting those deposit rates could be one way of doing that. Whether or not they actually drive it the other way is an open question.
What about the real estate market landscape in Canada right now? We've still got this bubble word floating around, although another tightening of Canadian mortgage rules came into effect last week, hoping to help bite into demand. Do you think this will help cool down the housing market significantly? And also, Rob, some say there were already signs to suggest the Canadian housing market were already cooling down before these new mortgage rules kicked in.
I think it's been as a sort of ongoing, long-running saw, this one. credit growth has been growing faster than disposable incomes, and I think that's the key that the Bank of Canada will be looking for there. That's the thing that I think ultimately is going to drive a bubble in a property market, and whether prices are going up or going down. The real factor is, are they going up or going down in an appropriate fashion? With credit still growing faster than household disposable incomes, you'd have to probably be a little concerned in terms of the property market remaining overheated, and until I suppose we could call them macro-prudential measures to keep the housing market under control, until we get a bit more evidence on that, I think we'd probably maintain a cautious view on that before assuming that enough has been done. I think these things tend to be a bit clunky. Interest rates are a much better way of controlling these markets' prices.
Finally, Rob, what about this strong inflow into Canadian assets that we are seeing? Foreign demand for Canadian securities, in particular bonds, hit a record high in May. Does this not strengthen the case that perhaps Canada is gradually becoming a safe haven, given Canada's slightly better long-term outlook?
It is. Actually, again, in terms of the sort of safe haven status, okay, the US gets the sort of automatic safe haven status just because of the size, the depth and liquidity of its markets. But actually, looking at it on a fundamental basis, it can't hold a candle to the Canadian economy. Canada's its debt GDP ratios are way better than pretty much anywhere else in the G7, and put it right at the top in terms of countries in the developed world. Its deficits are low. It's got a little bit of tightening coming through over the next couple of years, but the fiscal drag that we're going to see in Canada is minute compared to that which is coming down the pipeline for the US and which is already underway in Europe. So, the future doesn't look bright for anywhere, particularly in developed markets, but if it looks at all bright anywhere, it's Canada in the G7.
Rob, thank you very much for that. Great to speak to you on the matter. Now, I'm afraid that's all we've got time for the moment, but stay tuned to Dukas Copy TV for more financial news and updates. Goodbye for now.